If I told you I could have got you 18.7% a year returns over the last 20 years, would you be skeptical? I certainly hope so. And I'm going to share with you today why you should be. And when you read other people writing about their models that had these kind of rates of returns, you need to really run for the hills. Don't walk, run away. And we're going to dive into that here today at the Heritage Wealth Planning YouTube channel. Thanks for joining. If you like what you see here, please, by all means, click that button right there to subscribe. And then hit the little bell up there to be notified of our future content. We do one video a day right now, actually, and that's pretty exciting. We're going to share with you lots. And today we're going to talk about investment strategies, but we're also talking about retirement planning, tax planning, Social Security planning, estate planning, cash flow, you name it, we're going to talk about it. So welcome aboard. All right, so I just, in my morning readings here, I came across an article that talks about Jeremy Siegel. And Jeremy Siegel had written one of the biggest books of the investments that's out there, called Stocks for the Long Run. I had initially read this in 1994, and actually when the author did as well. And I might have been the first, the debut of the Siegel book, Stocks for the Long Run. It might have been actually, but it's just great. It's just a modern history of the modern investment world. And he goes back beyond 1926, which I call the modern era, all the way back to like 1870s and whatnot. It's a fantastic book. And so this author cited it. And the minute I saw the name Jeremy Siegel in the title, I said, oh, that always piques my interest because I'm a big Siegel fan. But anyway, so this guy says that he's able to extrapolate some of Siegel's work and actually have used that in his model to really boost investors' returns. Now, the funny thing is he isn't just saying, and I'm not going to name this guy or the article, but he isn't just stating the model work. He's actually stating the numbers in the table below come from actual client accounts beginning in 2002. So it's now 2018. So we got, 17 years of track record. And prior to 2002, he was using about 3 years of back testing to get his 20-year rates of return. Again, this is literally, according to this guy, this is from client accounts, not just models. All right. And wow, if that's true, then we all should quit and just join this guy. All right. So now I'm just going to read verbatim because before I show you the table that he's showing us, you got to know the context. So again, the numbers in the table below come from actual client accounts beginning in 2002. Prior to that, the numbers come from back testing using the identical strategy parameters. Let me just pause for a second. Anytime you hear the term back testing, you should always get nervous because back testing, you can prove anything. You can prove Hillary won. You can prove Trump. You can do whatever you want. It doesn't matter. Anytime you're back testing stuff, what they say, you torture the numbers well enough to make them confess. That's one of the terminologies here. You can torture the numbers any which way you want to validate what you're trying to push. I'd like to draw your attention to the sixth strategy in the table, the recession defense strategy. This is what I use to capture the 4 to 5% bonus returns from timing of the business cycle as described in Jeremy Siegel's book, Stocks for the Long Run. I'm not going to get in that in this episode, but basically Siegel says if you can do a certain thing, i.e. get out when the markets are going down and get in back up before they go up, you can make a lot of money. In fact, Siegel says you can boost your returns by 4 to 5%. All right, and this is interesting, but that's on the recession defense strategy. The recession defense strategy is, again, my model says we're about to go into recession. I'm getting out of the market. My model says we're about to get out of the recession. I'm going back in. Recession, I'm going back in. That's the recession defense strategy. The returns for the recession defense strategy are the same as they would be for a traditional buy and hold. A buy and hold is I'm just putting my money in an index fund and I'm just leaving it be. That's buy and hold, not messing around with it. So the returns are the same for both. For the time period that began after the last recession. So basically, they're saying at the end of the day, they follow each other after a recession. So basically, they're tracking. One's going up, the other one's going up. One's going up, the other one's going up. This is because the strategy is only invoked in the early stages of the new recession forecast. So the recession defense strategy only kicks in when there's a forecast recession. And most of the time, the strategy will remain relatively quiet, operating in the background. Again, so he's saying the recession defense strategy does not kick in. It mimics the buy and hold strategy until there is a threat of a recession. Once the model raises the alarm for a recession, the returns of our buy and hold and recession defense begin to diverge. One goes up and one goes down. At the end of the full 20-year period, from 2000 going for the last 20 years, the recession defense strategy has outperformed the buy and hold strategy by 13% a year.
If that seems hard to believe, consider this. The last 20 years included 2 severe recessions and 2 severe bear markets. This is what I love it. All an investor had to do was get out of the way when the warning signs were there and get back in when the model sounded the all clear. All the infamous models. That's all you have to do. And yes, it can and has been done. And according to this guy, he's going to show us with actual client accounts. So let's go back to the table he shows us, and this is what he's using for show his actual client accounts. Here's a buy and hold strategy up here. And you can see he's over 20 years has averaged 5.4% on annual. So 5.4%. And I'm not sure if this is stocks, bonds. My presumption is the total stock index. I don't know that for sure. Frank, I don't care because we're comparing buy and hold versus his recession defense strategy. So over 20 years, the buy and hold, just leaving it be, has averaged 5.4% a year. According to him, with his actual client data, he's averaged 18.7 over those 20 years. So I take my trusty calculator. When I first got in this business, these calculators were expensive, and now they probably cost $25. You can get them on Amazon. I don't even know if they're $25 even. Texas Instruments BA2 Plus. So I have a number of these because they're so doggone cheap, and you need them. And so I said, okay, if this guy was right, I'm just curious. What if I took $100,000, gave it to this guy 20 years ago, and I got, 18.7% rate of return, and I made no other payment. So I'm saying, here, dude, here's $100,000. I'm going to give you 20 years. I'm not making any more payments. And what am I going to walk away 20 years later? I'm going to walk away with, I don't know if you can see that, $3.08 million. The absurdity of it boggles my mind. And the idea that this guy says he has client data, I just don't believe it. Frankly, I don't believe it. You're going to tell me you're a better investor than Warren Buffett. I'm sorry. I just don't believe it. Because look at all these models. Here's somebody theoretically who did the financial and technical. I don't even know what that is. Don't care to know. High quality, value plus. I mean, these are all models. And the funny thing was, when you have these models, my friends, the thing that's annoying is everybody else is exposed to them too. Everybody else and their computer algorithms are exposed to them too. There's no, what's the word? I don't know. There's a word I'm looking for where you can't get it. The illusion. I'm not sure what it is. But there's no investment way to outperform other investors time and time and time again. There just isn't. Because what happens in the investment world is with all these hundreds of thousands of other investors plus their algorithms, if one thing starts varying to the positive, what do you think happens? Everybody and their mom follows that, thus eliminating the excess and what's called alpha, the excess returns you get from following that model. It's oh my goodness. So sector rotation, I mean, all these things are models. They're saying, if you would have done this, you would have that. I 100% get that. That's called backtesting. If this, then that. But this guy isn't saying backtest. He's saying this with actual client accounts. And he's saying his actual client accounts over the last 20 years. And again, like you said, during the worst recessions and worst bear markets we've seen since the Great Depression, average 18.7. It's crazy. And I don't, why is this acceptable to say this? Now, if he can prove it, hey, one of my favorite, what is it called? I'll eat crow. Absolutely. I just don't believe he can. Because I've heard this a million times a Sunday that people can do this, and then in actuality, they don't. And if they didn't do that, how do we know? Because they wouldn't be writing articles that said they did. For heaven's sake, why would you give away the store if you could do that? Why would not all the other smart guys in the world not follow the same model if they could do that? Why did long-term capital management, LTCM, with all the PhD, Nobel laureates, all the smartest guys with the computer algorithms, why did they blow up and burn out? Why did hedge fund managers all over the place blow up and burn out? We got example after example after example after example of people just blowing up and burn out because their models end up proving not to work. You know what works? Is sit back, not do anything. Buy and hold, buy and hold, buy and hold. Yeah, and there is a value proposition of some positive alpha by buying value stocks or small cap value stocks. So there is some evidence, and I hate to use that term because it's, again, back testing. And that has found its way into the vernacular in the markets, value, stock investing, small cap value particularly because of Siegel's writing. And Siegel's writing and French and Fama, who wrote a lot of this stuff as well. So there is and there's 5-factor, it used to be a 2-factor model. But anyway, there is a thought process that small cap value stocks outperform. The problem with that is if you take off this one little slither of the market, that goes away as well, because the models don't hold, because once the model is well known, everyone's going to follow the model. Now, at the end of the day, what works is buying low price stocks. There's just no other way. Value is going to work probably, and simply because it makes sense. If I'm buying a stock with a 30 PE or a stock with a 10 PE, my 30 PE is so much more highly priced than my 10 PE. It's going to be hard to maintain that 30 PE to grow unless their earnings are just going through the roof, because everything is based on earnings. Whereas I'm buying a stock with a 10 PE, PE is just price to earnings. I can buy a lower price stock, and all the earnings have to do is grow a little bit for the lower price stock to get a higher price because the earnings are growing. And I mean, that's just basic math. If I can buy a low price stock and you can buy a high price stock, if they have the same earnings, my low price stock should outperform the high price stock simply because it's already trading low. That's what value is. And I tend to actually believe that without question. I think it's probably not a bad idea to overweight value in financial markets. But at the end of the day, I frankly just buy the index and be done with it. It's the only way to do it. And of course, this doesn't take any consideration of taxes either. I mean, my goodness, recession's coming, sell. What does that do to your tax situation? It's silly. So that's what I just want to point out. Not a huge topic here today. Investment models drive me crazy. Everyone, the golden goose, there's a word I'm looking for, and I can't think about it, but everyone's looking for that golden goose of the investment market. Show me this, and if I can do this, I can make you a lot of money. So just pay me 2 and 20. Hedge fund managers, 2% annual fee, 20% of profits. Don't do that. No. Or just pay me 2% to manage your funds. Nope. You're not going to get it. You're just not. And again, if this guy can prove that he was able to do it, that's fine. I highly suspect that's not the case, and I don't think so. And even if he were to, which again I don't believe he could, will that same thought happen in the next 20 years? No, because it's water under the bridge. Remember Peter Lynch from Fidelity? He had a couple good stocks and it made his career. He's a wealthy, well-known investor. Could he come back and do the same? Highly suspect not. The good investors that you hear about a lot of times is attributed to luck. You're always going to have some outliers without question. Some get lucky, some don't. Others, like Warren Buffett, have the ability because of their previous prowess to draw money in, to keep a lot of cash on the table. So that way, when things go dicey, they're the only game in town where they can actually spend some of that money on low price stocks. That makes sense. But the vast majority of investors, I'm sorry, it just is not there. So to wrap this up, when you see an investment model that is just too good to be true as 18.7% over 20 years, again, that means I put $100,000 in. It's not worth $300,000. It's not worth $1 million. It's not worth $2 million. It's worth almost $3.1 million. Yeah, just run. You just got to run. All right. Hope you find this helpful. If you like what we talk about here, don't forget to subscribe. Like I said down below, just hit the notification bell to be notified of future content. Go to the webpage at heritagewealthplanning.com. That's where I keep my blog. heritagewealthplanning.com. I do my blog and my podcast, the Josh Scanlon podcast as well. And then lastly, if you like, if you want to talk about this, give me a thumbs up or just put comments in the comment area. Look forward to seeing you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.